And what you can see is that the period during which yields were coming down and values were being driven up very strongly in Europe coincides exactly, and when you analyse it, it coincides exactly down to the quarter with this period of the perfect calm. So it was sentiment that was driving things. Now, you can actually split that into two fairly distinct periods. The first half of this period, perfectly legitimate. What investors were doing was saying we were coming out of the 2000 recession, we're starting to see economic activity building, we've got a great low inflation environment because of the benefits we're getting from globalization and China, interest rates are low, and therefore incomes are going to go up, companies are doing well, we're going to see values rising and rents rising, so it's a good time to buy real estate, hence yields coming down, and that's perfectly legitimate. The problem started around halfway through that period. And this is where the risk, the wider capital markets risk issue came in. Because in the financial markets, the banking markets, they were starting to lend very aggressively into real estate at very low interest rates of progressively higher and higher capital values. And what we saw was debt-fueled investment, and this is either balance sheet lending or securitization or CMBS, all sorts of things. More and more debt coming into the market, fueling buying activity, pushing up prices. That sucked in more buyers, more debt, and the whole thing went into a spiral, which is what drove yields right the way down. And then we come to that point, which initially in 2007 with the US subprime crisis, and then as we came into late 2008 and Lehman Brothers and so on, the GFC kicked in, and at that point, that was when sentiment blew out and prime office yields started to move back out very rapidly.
Yeah, well, it's interesting because there is indeed a correlation here, or an inverse relationship. As the fear factor rises, the yields should be blowing out. But interestingly, in the last couple of months, the fear factor has increased due predominantly to the European situation, yet yields haven't blown out. So could they still sort of move up in response to that fear factor?
It's possible, but we don't actually think it's likely. If you bear in mind what it is that's been happening in the market, what's driving that sentiment index back up again now, the fear index back up, is this government bond issue. Now, when we think about, from a theoretical point of view, about the pricing of prime real estate, your starting point is government bonds, because the government bond is the good proxy for the risk-free rate, and you then adjust for additional risk or return expectations from real estate. This sentiment is about increased risk in government bond markets. So what that means is that actually that prime government bond isn't a risk-free rate anymore. In Greece, it's anything but. But the risk of default on government bonds going up, well, that risk of default on real estate is already priced into the real estate market. That's a key factor of the risk on the real estate. And if you look at where yields are, our index is about 5.75%, but in many markets you're looking at 5.5%, 6% for prime real estate. Greek government bonds are at 10%, showing that risk. But German government bonds are at about 2.6. US bonds at about 3, UK at about 3.3. So you can see there's really quite a significant spread, 300 basis points or more, between government bond yields and prime property yields. So there is scope there for bond yields, even in core Western Europe, to rise and compress that margin without necessarily having a kick-on effect into the real estate market.
Let's focus for a moment on what actually investors are doing in Europe. What sort of property are they interested in focusing on? Where, when are they getting in? Let's focus more on investor strategy.
Yeah, I mean, if you look at what it is that people are doing and what people are buying, all of these factors are just so influential on what it is that investors are actually doing. Because for all of these risk and concern reasons, the huge amount of the investment activity that we're seeing at the moment is very focused on the prime end of the market. Because overwhelmingly, it's defensive in nature. What people are looking for are the better quality properties. Prime defined, yes, in the traditional sense of being a good quality building, a good quality location, but particularly at the moment, it's the income characteristics. So have you got a good quality tenant? How long is the income stream on which you're depending? In other words, people are buying a kind of quasi-bond type, or the bond end of the property market. And real estate offers some very attractive characteristics at this particular stage in the cycle, particularly at that prime end, because it sits somewhere between a bond and an equity. From a bond point of view, you've got a contractually guaranteed income. In many markets, you've got indexation, so that you've got some kind of inflation hedge in there. In the UK, you've got very long upward-only rent review clauses, so that you'll get pretty much guaranteed your income as long as the tenant stays in the building. So that's very bond type. On the other hand, if we see growth coming back, if the economy surprises on the upside and you get pressure coming through in the occupational markets, then you get rental growth and you benefit from sort of equity-style value increase and income increase. So it sits somewhere between the two. But also very important is the fact that property is a real asset. It also has kind of gold-type qualities about it, in the sense that if all else fails, you still have the property. And a good example to think of is Lehman Brothers. If you'd owned Lehman Brothers equity or Lehman Brothers debt, when the company collapses, effectively you're left with nothing. If you owned Lehman Brothers headquarters building in one of the cities around the world, the chances are that that building, even though it may have been vacated, the building can be relet and you've got an income stream again. And in times of extreme uncertainty, that's a very, very attractive quality. And of course, at the moment, that's what people are out there looking for, but there's a relatively limited supply of it, which is why supply and demand works in the investment market, same as it does everywhere else. That's why, even though you may not necessarily think that the fundamentals look as though they would support strong investment into real estate, in fact, from a sentiment point of view, it does. And that's why yields are coming down, because people are competing for those products that are available. Not only is it attractive relative to other assets, it's also quite attractive relative to pricing in history, that even after the yield shift that we've seen, it still looks like, from a cyclical point of view, quite an attractive time to buy into the market. But I have to stress that here we are talking about that prime end of the market, and outside a couple of the markets where we're seeing some more significant rental growth prospects coming through, there's very little interest in the secondary, riskier, active management end of the spectrum.
Yeah, look, I think that's a similar theme in this part of the world. So in some ways, the investment markets here are similar to the rest of the world, but we're moving ahead on the occupational side and the leasing, the demand side. Yep. Let's have a look at that pricing issue a little more closely, Nick, and the timing question.
Yeah, I mean, why is it that we're saying that core markets don't particularly look badly priced? Well, what we've done here is not so much look at rents or yields, but look at the just absolute capital values. Now, clearly, because rental levels are different and yield levels are different in different markets, it's very difficult to compare that in a sort of dollars per square metre sense. But we can do exactly the same thing, but just by comparing the spot price in markets at different times relative to that market's long term, by which we mean 20-year average. So the movements in the line are just movements in value up and down, but they're just relative to the long-term average. And what that shows, again, is that strong cycle picture that we've seen before. But what you can see is that at the top of the market, pricing of property, and we haven't messed around taking out inflation or doing anything with this, this is just the rent yield capital value. What you see is that the market's got to anything more than up to double, or in some cases more, the long-term average value. So clearly, that was a bubble-type market. But what we then saw, of course, was yields moving out, rents moving out, moving downwards very sharply as well. So that if you look back to just sort of 12 months ago, latter part of last year, early part of this year, the City of London office market was, for prime property, you could buy that prime property at 25% below its average price for the last 20 years. And that was at a time when sterling was widely regarded as just being undervalued. Sterling was undoubtedly cheap. So for a longer-term strategic investor looking to get into the market, London and Paris was in a pretty similar sort of situation. London and Paris, two of the biggest, most liquid property markets in the world, and liquidity risk is another factor that's driving investor sentiment. Looking to get into those markets at what still looks like really quite an attractive point in the cycle, provided you're buying for that longer-term hold and you've got a tenant on the hook who is going to be paying the rent for the next 5 or 10 years at least to get you through the short-term dislocation.